Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Happy Monday. Welcome to the show. We have a big show in front of us today. We, of course, have a tremendous macro week on the economic calendar for this week. And so what we're going to do is we're going to just lay it all out there. We're going to go through and look at everything that is going to have the potential to be market moving in this critical narrative that we've been building for the past several weeks around how the fight with inflation that central banks have been attempting to conduct for the better part of the past year and a half has been shaped by the specter, let's call it, of banking crisis. We've had some bank failures, we've had some bank mergers, and so what we've seen is a dramatic shift in policy expectations to reflect the fact that central banks now have to walk this narrow path between not crashing the financial system while still dealing with an inflation issue that remains. And so on the agenda this week is a slew of data that will shape this story, and we're going to go through as many of the key touch points on it as possible. Let's begin. We start our conversation with the Bank of Canada and the first indication there, which is going to be Canadian inflation. We're going to see, according to expectations here, that the headline number is going to come in from 5.9 to 5.4% year on year in February, that the core number, which excludes volatile items like energy and food, is going to come in from 5 to 4.8%. So the message here is a bit of disinflation in Canada. Looking at how that stacks up relative to what has been developing in markets. We have, on the one hand, a bit of encouragement here. 5.4 is a meaningful move, extending what has been the tracking with about a 2-month lag of actual inflation numbers, that's in the red there, behind expected inflation. What you see in the orange there is the 5-year break-even rate. We're going to look at a lot of break-even rates in this conversation, so let's quickly define them now. What break-even rates are? That's the bond market's expectation for inflation as it is priced into actual government paper. So what you see when you look at the break-even rate is the difference between nominal 5-year bond yields and inflation-adjusted 5-year bond yields, real bond yields. When you take that difference, you get the inflation adjustment that you have to apply to get from nominal to real. And that's the bond market's inflation expectation, in this case, over a 5-year period. As you can see, it's hovering right around the 2% mark for Canada. That's, of course, what the authorities are trying to do. They're trying to get it there. And so it looks like we're finding some anchoring at those levels. And helpfully, we have a situation where that has seemingly suggested that the Bank of Canada is getting its job done. Now, 5 years is a bit long. If we looked at something shorter term, which is more closely in line with where the policy window is, so maybe about 2 years, 3 years, it is a little bit higher. And one interesting thing is things have stalled. They're not continuing to come in. But this does appear to be encouraging. It does appear to suggest that if we get these numbers in line with expectations, that the Bank of Canada is on a path where they could relax things a bit. We see something similar in the relationship between Canadian CPI and housing. You can see housing in Canada tends to lead overall CPI by about 10 months. Of course, housing is the largest component of Canadian CPI, and so that's why we're looking at it here. And you can see that also encouragingly suggests that we are going to continue to head lower. And that also takes some of the pressure off the Bank of Canada. You can see that reflected in yield curves. So not much movement in the current yield curve in the solid there relative to what we saw a week ago. And that, by the way, is meant to say March 13th is a week ago. But you can see that we have seen a meaningful dovish shift in expectations relative to the last BOC meeting, which was not that long ago, just earlier this month. And of course, that's against the backdrop of the banking issues that we've been seeing. So a much more dovish outlook relative to there. You can see before we were expecting rates to peak sometime perhaps in September. Now we're looking at rates that, according to these expectations, have ostensibly peaked already, that are where they are, and that only go low from here, with a rate cut somewhere on the menu between June and September. And so you can see, whereas September was going to be a peak at 4.5, we now have that month, so around September, so 6 months forward from now, already at 4. So we're looking at a 50 basis point cut between now and when we thought we were going to have a peak in rates. So a very dovish shift in policy expectations here, which flies in the face of economic data that has been performing better than expected. And so here is the chief complication. This is the Citi Economic Surprise Index. It measures how realized economic data is doing relative to median expectations. Those expectations from surveys of market economists, typically done by either Reuters or Bloomberg or some such aggregator of a broad perspective on where economic indicators are going to come out based on various banks, analysts, and other economists' models. And here you can see we're not exactly surging. Economic data has been relatively anchored relative to expectations, but anchored above 0 on this index suggests it continues to have a tendency to surprise higher. That, of course, is consistent with Canada's exposure to the U.S., where the economy has been quite buoyant, which we'll take a look at in just a moment. And so the question really becomes, are these dynamics sustainable? Is this, in fact, what is going on, or might we get some jumping around here? Might we get an unexpected pickup in inflation if economic data is tending to surprise higher? And so therein lies a conundrum for the BOC. If you get a higher number, if the economy appears warmer than current readings suggest, how do you abandon tightening? And what kind of signal might you send? Now, of course, we're not getting a BOC policy announcement. It'll be just on this inflation number. So if it gets higher, the markets will naturally ask the question of, well, here was a central bank that appeared to have everything going for it as far as inflation being contained. If it can't step away from the inflation fight, what about some of the others where these kinds of things are not quite as advanced? The next thing we look at, of course, is one example where that's the case, the Bank of England. And first, we're going to get inflation numbers there. Expectations, again, for price growth to come in a little bit. Headline coming down from 10.1 to 9.9. You can see a world away from where we are in Canada, much, much higher. Almost twice the level of inflation there. The core number coming in 5.8 to 5.7. And then in the wake of the Fed, we are going to have a Bank of England rate decision where the expectation still is for a rate hike from 4 to 4.25%. Let's do this same calculus here. There's a 7-month lag, it looks like, between the 5-year break-even in the UK and UK CPI. You can see that break-even has been heading lower. It isn't quite approaching target. It's still north of 3, but it does look to be heading in the right direction. and the expected CPI reading at 9.9% would follow that and would be in line with this relationship. So ostensibly, for the Bank of England, as for the Bank of Canada, things do appear to be taking a turn for the better if this is realized. As with the Bank of Canada, you've had a meaningful shift in the yield curve here as well. And thankfully here it's labeled correctly. So what you have is, relative to last week, a move inward on the curve. Relative to the last BOE policy announcement, you have a move lower, but ostensibly not as dramatic of one. And you can see from 1 year out, looking further, you actually have a bit more of a hawkish view. So you can see the curve is a little bit less flat 1 year out, 2 years out, to 3 years out than it was in the immediate aftermath of the last Bank of England announcement. And here, the front end of the curve is not dramatically different. So this is an interesting area because, of course, the banking consternation has driven the yield curve down. Of course, there has been some weakness around all of these questions of bank stability and thereby the Bank of England's ability to continue, but not meaningfully so, at least for now. You can see, though, again, a complicating factor. Here, you can see the Bank of England is actually looking at, again, economic data that's improving relative to expectations, an economy that appears to be accelerating. So you do have, perhaps, the makings of inflation coming off a bit. But at the same time, you have an economy that's increasingly buoyant. That, on the one hand, suggests that economists' models are too pessimistic relative to realized results, creating the possibility of an upside surprise, as you did with Canada. Likewise, you have a situation where if economic data is doing better relative to forecasts, well, then inflation pressure should be higher than is expected in those same forecasts, because, of course, stronger economic activity is itself inflationary. And so we could see an upside surprise there. The upshot for the Bank of England, of course, will be how will the sum total of these things, coupled with a Fed announcement that will move ahead of the Bank of England and arguably define much of the macro environment before the Bank of England has their say, all of those things will enter into that calculus. And the Bank of England will be the first to get a crack at setting policy without upsetting the apple cart that is international financial markets in the wake of the Fed. The example that we had last week was the ECB. They came in before the Fed, but after the collapse of SVB and as Credit Suisse was grappling with its banking issues. Credit Suisse, of course, not SVB in the sense that it had issues for the better part of the past several years, but of course, in an environment where people start worrying about banks, Credit Suisse, a bank that's been bleeding deposits because of those issues over several years, naturally came onto people's radar. Now, over the weekend here, Credit Suisse has been merged with UBS to shore it up, but we nevertheless had an ECB before that that was able to get through the 50 basis point rate hike that they promised without the markets clutching their pearls too hard. And the message seemed to be, we think we can walk and chew gum at the same time. We think we can fight inflation with one hand, reducing liquidity for the economy as a whole, while keeping the banks liquid episodically as need be with the other. And so it'll be this that the Fed and the Bank of England need to manage as well. The Bank of England will be the first test of doing this after the Fed. And the makeup here continues to be that inflation seems to be near a top. Expectations seem to have become more dovish thanks to the banking stress, but the economy is still improving. And so we may not have the luxury of ending the inflation fight for the Bank of England, much as we do with Canada. So if we look at expectations as they stand now, we have only priced in a meager 50-50 chance of a hike. 48% now, so a little bit lower. We do eventually see that hike become more likely. So we do eventually get a little bit higher to about 417 come June, but it is questionable as to whether this next hike is going to occur. We've only priced in a bit of it. And so if you look in a cumulative way, it's mostly priced in come June. You can see we're at 24 basis points cumulatively by then, but the market is decidedly unsure. And once we get to the end of this year, we're flat. So if there is a rate hike, then we're not going to keep it for very long. We're going to have an offsetting cut, according to this, by the end of the year. Now, to the extent that economic activity being buoyant continues to be something that the Bank of England needs to contend with as inflationary, that could be something that is rethought, especially if the Fed manages to land safely. Which, of course, brings us to the Fed. For the Fed, we're looking for a hike of 25 basis points still, albeit very narrowly. And the story here, which of course is relevant to Canada, which of course is relevant to everywhere else, is that since the beginning of February, U.S. economic data has done exceedingly well. And the economy has very pointedly heated up. This is a risk, of course, of greater inflation and has knock-on potential on economies like Canada and others. The U.S. is, of course, the world's largest economy. So what happens in the U.S. oftentimes has a very significant knock-on effect. And, of course, in the case of monetary policy, doubly so because of the ubiquity of the U.S. dollar. So this is still the story here. Much better economics in the U.S. on the growth side of things. And you can see that in February, that gave us a break-even rate in the yellow bars there that jumped significantly higher to 3.2%. In March, we've eased back now to 2.6, but we're still off target. We're still not getting to the Fed's 2% objective in the window that the Fed has set out. Here we can actually look at a liquid 2-year break-even and get a look at what happens inside the Fed's actual policy window. So not a 5-year break-even, not anything longer, right in the window that the Fed lives in. You can see that those 2-year break-evens have been leading realized inflation measures, both PCE and CPI, by about 2 months. What that suggests, if these things continue to develop in this way, is that we are going to have the appearance that the Fed has under-tightened, not over-tightened. And so with this robust pickup in economic growth, the Fed faces much the same issue. Can it manage to continue to keep the pressure on? Can it continue to fight inflation with one hand while keeping the banking system anchored with the other? You can see here you've had a significant shift in expectations. So you've had a little bit of an improvement in the curve since last week, but certainly a dramatic flattening of it since the last Fed policy announcement. You can see the peak was expected in September north of 5%. It is now expected by the middle of the year and under that number. 4.87 is the peak there. And if you look at what expectations look like for the Fed, we've baked in 68% chance of a hike. You can see there in the percent hike cut column. So we've accounted for 17 basis points of the 25 that would be one hike. You can see that's in that implied rate delta column. If you look then at the implied rate column, you can see we're currently at a setup where we're still looking for hikes. You can see here we are currently just in that 4.5 to 4.75 range, 4.62, and so what we are looking at come March is just on the cusp of 4.75, and then come May, it looks like we're edging a little bit deeper, but notice there are no more fives here. And we come right back to at least one cut and the 50% chance of a further one by September, two cuts by November, and a significant probability of three cuts come December, January. So this is probably the most extreme version of this case, other than the one we'll talk about in just a moment, where there aren't even any rate hikes on the menu. But here, we are looking at a situation where, despite the fact that the economy is surging, despite the fact that this is inflationary, the markets are expecting steep cuts and a much lower peak rate than even just a few weeks ago. And incidentally, a lower peak rate than what the Fed guesstimated in December, which it has since said was too low. So again, you have this narrow issue here. This is the crux of what's about to happen this week. How do you walk this line? On the one hand, saying we are going to have enough liquidity for the banks. On the other hand, saying we want to pull liquidity from everywhere else. The ECB managed it, which was encouraging. The markets don't think that officials are going to try to manage it. They think it's the rate hike side that gives. But the ECB didn't let the rate hike side give, and the markets rewarded it, the ECB for it, with a stable performance from European stocks, in particular financials, with a stable euro. And so there's an interesting dichotomy here whereby if what the Fed says is more hawkish than these very soggy expectations now anticipate, but at the same time engenders confidence and says this banking crisis is not anything to worry about at a systemic level, we have the tools to deal with episodic stress, then you have a very significant upside risk for the dollar, downside risk for bonds, downside risk for gold, upside risk for yields in what we're going to see this week. And finally, we have the Bank of Japan. And again, no policy announcement this week. We just had one last week, which ended up being a big nothing in the last meeting for outgoing Governor Haruhiko Kuroda. He will be replaced by Governor Ueda at the next BOJ policy meeting. Here we're going to get the leading indicator of significance. We're going to get CPI. That's expected to come in from 4.3 to 3.3, so a very significant decline in the headline. The core, excluding food and energy, seen coming up actually from 3.2 to 3.4. Excluding food alone, seen coming in very substantially from 4.2 to 3.1. So you can see it's really the food component that seems to be the most significantly inflationary one, and that, of course, makes sense. If we look at what's going on in Japan, you can see that its inflation move has largely tracked the Bloomberg Commodities Index, implying that a lot of the inflation in Japan is imported. You can see their five-year break-even rate stopped rising and flattened just as that commodity index topped out and started to come in as well, and give us a little bit more of a flattish to lower view. With that, you can see CPI is expected to come in to 3.3, matching what's going on in that commodities index. CPI here lagged 8 months behind it. And so the expectation would be that inflation heads down from here. You can see a similar, very dovish shift in the curve, going from a much more hawkish setting since the last BOJ meeting just a mere 10 days ago. And even coming in as relative to a week ago, which is only just a couple days after that last BOJ announcement, and giving us a yield curve that doesn't seem to be going very far very quickly. There was some expectation that this new BOJ governor might take us into a place that's a little bit more hawkish, might start to talk about ending of yield curve control. That's not what the shift in this curve is saying. It's suggesting that actually there's been a dovish pivot in expectations, implying that Governor Ueda is not going to do anything aggressively hawkish, at least in his first go-around, and probably not for a while. But again, improving economic data is the contrast. Here's Japan's economic surprise index. It is heading higher. So once again, we have this dichotomy between, on the one hand, inflationary growth conditions, on the other hand, a central bank that wants to deal with those inflationary growth conditions in all kinds of different places, in the US, in Canada, in the UK, perhaps increasingly in Japan. But what you have is then this banking crisis, which suggests if you over-tighten, then you could collapse something in the financial structure and in the credit structure. And so it is walking this fine line this week, and the various indications to suggest how policymakers might walk that fine line and whether doing so would be successful, that will be in focus. The biggest risk here, the biggest asymmetry in the positioning seems to be that the markets are too dovish in their perception of policy, that inflation is still too high, that central banks still need to go harder and will, most importantly, the Fed. And that would, of course, put the markets off sides in terms of where they think Fed rate hike odds and elsewhere as well will peak, and the extent to which the dollar has sold off will look excessive. The extent to which gold has rallied will look excessive. Bonds are going to start to look cheaper as yields come up. Stocks might well wobble, not only because they would expect further consternation as this tightening becomes more significant, but also as you get generalized risk aversion around the idea that you have a central bank that will continue to increase the hurdle rate on investment in much of the world, that no one has blinked, as it were, amongst global central banks. And of course, if somebody does, that will be perhaps a little bit less market moving, because the markets have already gone there to a significant degree. So the surprise risk appears to be on the other side. And the ECB would suggest markets might actually welcome it if it's done elegantly enough. And so a very action-packed week here in front of us, and all kinds of opportunities for markets to hang on every little bit that crosses the wires as they try to make heads or tails on how global policy officials will both not crash the credit markets and contain inflation at the same time. This has been Macro Money. I am Ilya Spivak, head of Global Macro here at Tasty Live. You can catch me on this show Monday through Thursday. I'm on Futures Power Hour with our friend Chris Vecchio, head of Futures and Forex. and that's on Friday. I'm on Overtime with Chris Monday through Thursday, right before this show. And I'm on with Tom and Tony on Sundays for First Call. Outside of those shows, you can catch me on Twitter at Ilya Spivak. Thanks very much, everybody. Godspeed this week. We'll all need it. We'll speak to you tomorrow. Take care.